Hello everyone. In this video, we're going to be going through the topic of assessing the collectibility of a notes receivable. Okay, so basically how companies measure collectibility. Okay, they do these different steps. Okay, and so we're just going to walk through the steps of how a company would do this, and then we're going to go through a problem and kind of see with concrete numbers how that works. Okay, so basically, first a company must determine the investment it has in the notes receivable or the loan. Okay. This is defined as the principal plus accrued interest on the note or the loan. Okay, and we'll see what exactly that means when we go through the problem. Okay, but just to keep in mind, the investment in the notes receivable or the loan is principal plus accrued interest. Okay, next, second, the company must determine the expected future cash flows from the note or the loan. Third, the company discounts the expected future cash flows at the note, receivables, or loan's historical effective interest rate. This is told to us by GAAP. Okay, that we must use the historical effective interest rate of the loan. Okay, and so basically we're going to be told in the problem what is the historical effective interest rate of the loan, and it may not say it in those specific terms, but it's going to give us an interest rate that is the interest rate for the loan, and that's what we need to use to discount the cash flows. Okay. Fourth, finally, the company compares the investment in the notes receivable, which is from step 1, to the sum of the discounted future cash flows, which was from step 3. And then if the sum of the discounted future cash flows is less than the investment in the notes receivable or loan, an impairment has occurred. Okay. And then to record the impairment loss, the company debits bad debt expense and credits allowance for doubtful accounts. Okay. So basically, if the discounted future cash flows are less than the investment in the loan, then we have a loss. Okay. And this kind of makes sense because the investment in the loan can kind of be seen as the investment's carrying value or book value, right? And if the future cash flows, which represent a fair value to us, if the fair value is less than book value, then that's kind of like a loss, right? Because that means that we're not going to get as much value as we thought out of this investment, out of this loan. Okay. So basically, we have an example. On January 1st of 2016, the First National Bank of Gainesville made a loan to Bill for $200,000. Who's a small business owner. The loan calls for Bill to pay interest at a rate of 6%. This will be the historical annual rate. Historical annual rate. Okay, just so that way we note. Okay, historical effective interest rate is just the rate that that Bill is going to have to pay interest at. Okay, whoever's actually paying interest, what rate are they paying interest at? Okay, that's the historical effective rate. And then that Bill is going to have to repay the loan, the principal of the loan, basically 4 years from when it starts, on December 31 of 2019. And then as of December 31 of 2017, so that'll be 2 years, right? Bill failed to make the first 2 years of interest payments on the loan. As a result, on December 31, the First National Bank is performing an impairment test for the loan. Okay, the expected future cash flows are as follows. Okay, and then it gives us the cash flows, which we're going to need to use. And then it says required. Determine the amount of impairment loss the First National Bank of Gainesville has suffered with respect to the loan, its loan to Bill, and prepare the journal entry to record the impairment. Okay, so basically, as we can see here, it says, okay, this guy doesn't pay us, right? And so that's why we're worried about the loan being impaired, right? If something is impaired, that means that if an asset is impaired, it means that we don't think we're going to get the full value that we initially thought we would. Okay, and so the thing about that is that that's when we are worried about impairment. We're worried when people are not paying us interest payments and stuff like that. We're worried that we may not get the full value of the loan. Okay, and that's when we're going to do these impairment tests. Okay, so now we just have to go through the steps that we have above. So the first step is determine the investment in the loan. And again, the investment loan is the principal plus accrued interest. The principal is pretty easy. It tells us it's $200,000 in the problem, so that's easy. The accrued interest part is a little bit more challenging. Okay, so what is accrued interest? Accrued interest is basically defined as the interest that should be paid, okay, each time that there's a payment date coming due. Okay, so for instance, as of the end of December 31st of 2016, Bill should have paid First National Bank a certain amount of money. Okay, they should have paid them an interest payment at the rate of 6% per year. Okay, and if they don't pay it, then it becomes accrued interest because the interest is accrued in the sense that it isn't paid, but it's still owed to the First National Bank. Okay, so in this problem, we actually have 2 years of accrued interest. So what we need to do is we need to take the principal multiply by the interest rate, and then multiply by the number of years that the person has not paid the interest, okay? And so basically, it will be $24,000 in this case because it's $200,000 loan, 6% rate for 2 years. That gives us our investment in our loan of $224, okay? Then we see for step 2, we want to determine the expected future cash flows, okay? These are given right here in the table, right? It'll be $216,000 total, okay? Step 3, it says determine, you have to discount the expected future cash flows at basically in this case 6%, the historical rate, right? Again, we said it was 6%. So if we just discount these cash flows at 6%, we will see that the 2018 cash flow would be $7,500 basically. 2019 is $185,119. If we total these up, we get $192,666 as our total discounted cash flows, okay? And then step 4 is now when we're determining whether or not there actually is an impairment, okay? And again, if the sum of what we did for number 3 is less than the actual investment in the loan, which we're going to see in this case it is, we have an impairment loss, okay? Because again, basically, these future cash flows, that's basically like a fair value to us, right? Whereas our investment is like our book value, right? And so if our fair value is less than our book value, that means we have a loss, right? That means that essentially, if we were to try to sell this asset today, we would incur a loss, right? And so that means we're not going to get the full value of the loan, okay? So now we have to compare the investment in the loan to the total discounted future cash flows. We see the investment was $224. We got that from step 1. The total discounted cash flows is $192. We see that right there, step 3. Basically, then we just prepare a journal entry, okay? And it says to prepare it as of December 31 of 2017 because that's when the impairment actually has occurred. And the reason we know it's incurred at that point is because it's telling us in this problem, it's telling us that they're doing an impairment test on December 31 of 2017. Okay, and so December 31 of 2017 is the first time this company is worried, this First National Bank is worried about there being collectibility issues. And so the first time that we're worried about there being collectibility issues and we're performing our impairment test, that's when we record our loss. Or in this case, it's technically bad debt expense, but it's basically an impairment loss, okay? And so the way that you calculate the impairment loss is literally the difference between these two numbers. That's 334. So 224 minus 192,666 gives us 31,334, and then it's just bad debt expense and allowance for doubtful accounts or the accounts, and those are always the same accounts. Okay, very similar to like an accounts receivable. This is a notes receivable, so it's very similar with the journal entry. Okay, so basically that is this section. One last thing is that's this topic. A lot of times the problems don't include things like accrued interest. So if you don't have accrued interest in the problem at all, then you kind of just ignore it. But sometimes you just have to worry about the principal. Sometimes you don't have to worry about accrued interest. But I just thought, let's do the kind of one of the hardest problems we could possibly think of just to see what that would look like. Okay, so that's basically this topic. I hope that was helpful.